Well, good morning, and yes, here I am again at this Grand Central Station in New York City. And here I got my famous New York City coffee cart coffee. Today is Wednesday, May 1st, 2024, and I am Kenny Polcari, your host of the party. And what is it that we need to know today, and what happened yesterday on the final trading day of April, right? It was a crazy day, but here are the things that you should consider. Stocks got punched in the face yesterday afternoon as Nikki Timrose from the Wall Street Journal revealed what many of us already knew. The FOMC announcement comes at 2 p.m., but the press conference is at 2:30 p.m., and that's key. And what will the market hear versus what he says? That's also going to be key. Oil and gold plunged yesterday, and what do we have for dinner tonight? We're going to have the simple pork loin. We'll get to that in a moment. So Wall Street was hit by jitters yesterday. Stocks ended April in decline, right? Investors are bracing for the latest FOMC guidance. Notice I didn't say the decision, but the guidance. The employment cost index, which is the labor cost, rose by the most in over a year, while U.S. consumer confidence plummets and stocks got punched in the face. But remember, it was the last trading day of April, which only means it's the end of the monthly marking period. It is not the end of the more important quarterly marking period. So let's just not get our panties in a bunch all yet, right? Today is May 1st, and the new trading month begins. Yesterday, the Dow lost 570 points, or 1.5%. The S&P down 80 points, or 1.6%. The NASDAQ gave up 325 points, or 2%. The Russell, taking it on the chin, gave up 42 points, or 2.1%. The transports lost 304 points, or 2%, while the equal-weighted S&P gave up 100 points, or 1.5%. In terms of performance, though, yesterday's decline did nothing to change year-to-date sector ranks, but did reprice how those ranks are performing. And overall, let's be clear, it has not been a disaster by any stretch of the imagination. The S&P group ranked returns reveals that communications continues to be in the lead, up 13%, energy up 11.7%, financials up 7%, industrials up 6.5%, tech up 6.3%, consumer staples up 5.5%, utilities up 5.2%, basic materials up 3.4%, healthcare's up 2.7%, consumer discretionary stocks up 0.2%, while real estate remains in negative territory, down a full 9.8% year to date. But if you look at yesterday's performance in a vacuum, it appears as if there was blood all over the streets. Energy gave up 3%. Consumer discretionary gave up 2.5%. Tech was down 2.2%. Basic materials and real estate down 1.8%. Communications lost 1.7%. Industrials were down 1.6%. Financials down 1%. Utilities down 0.5%. Consumer staples down 0.5%. Healthcare was the winner, only down 0.1%. So in the scheme of things, healthcare was the winner. Further down the scale, though, we saw weakness across the board. Home builders were down 1.8%. Airlines down 2.2%. Disruptive tech, right? ARKK is the symbol, down 3.7%. Semis down 2%. Expanded tech down 2.5%, while expanded tech software was also down 2.5%. Oil and gas exploration down 4.4%. Aerospace and defense down 1%. Metals and miners down 3.5%. Big pharma down 0.5%, and the list goes on. In the end, was it a down day, or was it? The VIX shot higher by 6.5% to end the day at 1595, well below last week's surge at 2150. I, for one, was a bit surprised with the move we saw in stocks yesterday, right? The performance alone in stocks would have suggested that the fear factor rose exponentially, which it did not. So for me, that just suggests what JJ's about to say, right? It's not unexpected. Seasoned investors know that it isn't a bed of roses. This is not our first rodeo. We can read the tea leaves just as well as the FOMC members and realize that rates aren't going anywhere today, tomorrow, next month, the month after that, the month after that, September, and most likely not even in November or December. And if you have been in that camp, then you should not have been surprised at all. I am, as you know, and have been very much in the no-cut camp all year. I've been saying it since the beginning. Now, the ones that appear to be surprised, though, were the trader types that created this false narrative, right? They were talking about multiple rate cuts. They pushed that false narrative and then they bought into it. How many times did we discuss this? The data did not and does not support any such thing. So it's time to let go, and let go they did, as they all ran for the door at the same time, which is always comical to watch, right? They have this herd mentality. They follow each other in and they follow each other out like a bunch of sheep. And in the end, we know that sheep get slaughtered, but that's a whole nother story. You can find it in Wall Street 1987 with Gorgon Gecko. Anyway, the contra trades were by default the winners yesterday, right? The SPSX, which is the Direction triple levered S&P short ETF, gained 4.6%. The VIXY, VIXY, was up 2.8%. The DOG, which is the Dow short, up 1.5%. The SH, which is the S&P short, up 1.5%. And the PSQ, which is the NASDAQ short, was up nearly 2%. Now, it was one of those Fed deep throat days, right? Nikki Timrose, the Wall Street Journal chief business reporter, chief economic reporter, who acts as the Fed's mouthpiece when they can't talk because they're in a blackout period. And right now they're in this blackout period, right? And that's what lit the fuse. He laid it out in a Wall Street Journal piece yesterday. The other deep throat here is Goldman Sachs, and I'm sure they're not happy that Nikki stole the spotlight because they couldn't take advantage of this news to create, one of their Goldman special reports. But hey, it's just business. Anyway, the article went on to say that the Fed to signal it has the stomach to keep rates higher for longer. That's about all you need to know. Using an ancient Chinese proverb, Nikki intimated, "Do nothing and everything will be done." That's all. That's all you need to know. There's do nothing. Nikki also appeared on Mornings with Maria on Fox Business, where he goes on to say that inflation appears to be settling in at 3% rather than the 2%, and that would not be ideal for the Fed. They will simply take away any idea of an interest rate cut this year and possibly into next year, and what that will do is cause interest rates along the Treasury curve to rise, right? Without the Fed actually raising rates. Although what Nikki did say is that rate hikes, in fact, are back on the table, which doesn't mean the Fed will raise them. It just means that they're not going to cut rates, right? Something you and I have been discussing. Anyway, let me be clear. The message that Deep Throat delivered was simple. Take rate cuts off the table, and he did. Remember, he said, they will simply take out any idea of an interest rate cut this year and possibly into next year. And boom, here we go. Stocks and bonds got smashed, right? Now, in the bond market, the TLT lost 0.8%, the TLH gave up 0.7, and that sent the 2-year yield up and through 5% to end the day yielding 5.03%. And while the 10-year gained 6 basis points to end the day yielding 4.688%. And that's the culprit. Rising rates. But we knew this. This isn't rocket science, which is why I keep asking you, are you a long-term investor or are you a short-term day trader? Because how you answer that question is gonna really kind of dictate how you react or how you reacted to yesterday's action. Because in the end, what really changed? Absolutely nothing. The message has been clear all along. Inflation has remained sticky. Month-over-month numbers lately have been on the rise. In fact, for 3 months now. And all indications were flashing, warning, Will Robinson, warning. Which is why I have been saying, do not get drawn into the fray. Create your plan and then you stick to it. Only change course if something fundamental changes. And for me, nothing fundamental has changed yet. Right? Now, oil gets slammed, falling 1.3% to end the day at 81.55, and this morning it's down another 1.9% at 80.39. U.S. crude inventories and production are swelling. Iraq crude exports are rising, despite a pledge not to increase production, and there are increasing hopes of a ceasefire in the Mideast, right? The API reported that U.S. inventories rose by nearly 4.9 million barrels, while gasoline stockpiles, in fact, decline a little bit. U.S. crude production is also ramping up. It's expected to go up to 13.15 million barrels per day, up from 12.58 million barrels per day. So more supply will put pressure on prices. Now, we did break the trend line support at 81.05, but not significantly yet, right? Let's see how the day ends. A close below this trend line will put us in a new range, 77.5, 81.05, while a close above the trend line is going to keep us in the $80 to $90 trading range. Remember, the summer driving season is about to kick off. Memorial Day is just 23 days away now, right? It's the 24th to the 27th. So get ready to keep paying higher prices for gasoline at the pump. And as you would expect, gold also got crushed, right? Falling $60 yesterday and another 80 cents this morning, trading at 23.02. This after testing a low of 22.91. Again, breaking the 2300 level that I had identified as support sometime last week. In my opinion, again, it was the herd mentality type of move. Everyone running for the door at the same time, right? So again, I ask, is the market really that surprised that rate cuts are off the table for now? Is it really a surprise? I mean, is it? And if it is, then you've been living under a rock. The message has been very clear. So I think in the end, we're going to find support for gold at 2,300. And while I don't think that the Fed is going to raise rates, they're certainly not cutting them anytime soon. And that's going to keep some pressure on gold. But I think right in here, it's actually okay. U.S. futures continue to come under pressure. Dow futures this morning are down 90, S&P's down 25, the Nasdaq's down 135, and the Russell is down 10. Now, no one should be surprised to see a bit more caution after yesterday's decline in what is sure to be another shoot first, ask questions later type of reaction, and ahead of today's all-important FOMC guidance press conference, along with the eco data that's due today. ADP employment, it's supposed to be up 180,000 new jobs, construction spending up 0.3, ISM manufacturing of 50, which sits right on the neutral line, and prices paid of 55.4. Remember, yesterday's employment cost index rose more than expected. The announcement, the FOMC announcement, is at 2, but the presser is at 2:30, and that is what the market is waiting for. What will JJ say? What will he waver in his commentary? Will he suggest something other than what Nikki said? Will he finally say what with full clarity, what we know, that rates are not going anywhere lower anytime soon? And even if he does, will the market hear what it wants to hear, or will it hear what he says, right? Because that's always the question. European markets are close to the May Day holiday, other than the UK, and that market's up 0.1%, nothing dramatic there. Now, remember when I said that we were going to test 49.50 before we tested 51.20, and then on Monday evening, Lonnie made the surprise visit to Beijing, and Bernstein upgraded Apple to a strong buy, and that caused the herd to push stocks up, the S&P up through 51.20 on Tuesday. Now, only for a brief moment, because remember, we did close below that at 51.16. While I did admit defeat, I also said that while we pierced it, we closed below it, which essentially really left us in the defined range that I had been pointing out. And then yesterday happened, taking the S&P back down to 5,035, right? I was just a day late and a dollar short. But hey, I remain convicted. I am still not convinced yet that the drawdown is over, which only means I still have cash on the sidelines ready to be deployed. I'm not a sheep. I didn't follow the herd, which doesn't mean my portfolio didn't decline. Just means I didn't get slaughtered. Owning some of the contra trades helped to blunt the bleed, while building a strong foundation is key to creating a long-term portfolio. The S&P closed last night, like I said, at 5,035. It was down 80 points. With futures pointing lower this morning, I suspect that a test of trendline support at 49.50 is in the cards. Maybe not today, but soon enough, where I think it will find support. So stay awake, right? Friday's non-farm payroll report is what's next. And like I said yesterday, I fully expect it to show a strong labor market and a strong average hourly earnings, both month over month and year over year. I also expect unemployment to come in at the expected 3.8%, still historically low by all standards. So sit down and strap in. This part of the ride is far from over. Call me to discuss. I'm always happy to discuss the plan and putting it all together and kind of remaining focused and becoming a long-term investor. Okay. So what do we have for dinner tonight? Well, I wanted to make this easy, right? Because it's a little bit nervous, so some people want something easy to eat. So this is an easy pork tenderloin, right? It's simple. It's one of those quick meals. It's always a winner. You can pop it in the oven. The whole thing maybe takes you 45 minutes start to finish. So for this, you need the pork loin. You need salt and pepper, beef broth, whole kernel corn. Not creamed corn, whole kernel corn, right? Preheat the oven at 375 degrees. Season the loin with salt and pepper and any other seasoning you want. I just use salt and pepper, keep it simple. Put it in the Pyrex baking dish, add the beef broth enough so that the loin is bathing, not so much that it's swimming. Cover it tightly with tinfoil and cook it for 15 minutes in the oven. Then take it out, remove the tinfoil, add the can of whole kernel corn, even two, depending how big the loin is, and then put it back in the oven and cook it for another 30 minutes uncovered. Now keep your eyes on it, as you need to add a bit more broth if it starts to steam away. Now while this is cooking, you make a nice side of brown rice, accompany that with some steamed veggies of your choice. French cut green beans always works well with this dish. When done, just remove it from the oven, slice it, right? If done properly, you can even shred it with 2 forks. Serve it over the rice with the corn and the veggies on the side. Keep it simple, keep it fast, and keep it easy, right? It's just one of those meals that's quick to make and always a fan favorite. In any event, the day is just starting here in New York City. I will be on Varney & Company today from 10 to 11 live in the studio, so be sure to watch. In any event, until tomorrow, take good care.